Good morning, everybody. Welcome to the Flow Show. So I was just scribbling down some last-minute headlines there that we just got out. Hope you're all well. I'm on my lonesome today. Kay's off on his jollies, and Stell's probably down the beach. So just me today, but lots to talk about anyway. So we shall get right into it. But before we start, just want to highlight here as you can see on your screen there, we have the Traders Summit coming up on the 21st to 23rd of October. If you haven't registered already, you can do so. I'll put the link in the chat there. As always, a big show. This is plenty of guests, lots of really good guests coming in here. Some you may know, some you may not know, but a real good stable of guests coming through here, including a good discussion. Peter Schiff and Danny Blanchflower talking about central banks and what's happening with those guys going on there. But tons of great guests coming through that. So if you want to sign up for that, please do so on the link there. We've also got a few giveaways on that. There's 2 Traders Funding Program accounts up for grabs for anyone who registers. 250k accounts, 2 of those up for grabs, and also apparently 2 iPhone 14s up for grabs as well. People will be picked randomly from those who register. So please don't register, because I could do with a new phone, and if I'm the only one on there, then I'll get it. If I get 2, then I'll sell one of you one for cheap. How about that for a deal? But jokes aside, if you want to sign up there, the link is there in the chat. Right, back to the important stuff, and we'll get onto that screen. You can see there the US CPI and inflation that's coming up. But before that, we'll just go through some of the headlines that have been out. Right, start with the ECB, actually. Something to look forward to at their October meeting. They could change the terms of their TLTRO programs. This is the targeted long-term refinancing operations. This is one of their many acronyms they put in place to provide liquidity and cheap loans to banks and whatever. They're going to potentially change the terms of these at the next meeting, whether that's to do with the interest rates or how much they're lending or anything. It's probably not going to be huge for the euro, but if it comes as part of a whole package of whatever they do in October, obviously QT's in discussion there as well, rate hikes, everything else that's going on. It's never as simple as just a rate hike with the ECB. So that's just something to keep an eye on, pencil down for October. We've had a bunch of ECB speakers coming out. The Guard was out yesterday. Nothing really of note. Continues to say that the ECB will be data driven and will take rate hikes or announcements meeting by meeting, sticking to her party line, if you like. But we've had a few of the others out, a few of the hawks flying the nest yesterday. Hawky Holtzman was out saying that while 100 basis points hike is off the table, he sees 75 pip hike in October and a 50 pip in December. That would get the ECB to neutral. Just to put that in numerical terms, that would mean he sees the main refinancing rate at 2.5% and the deposit rate at 2%. He also said that a shallow recession will not stop the ECB from hiking. I'm sure he'll face an argument on that. As said, he is hawkish, but he's happy to go hiking through a recession. Pretty much as the Fed are doing now. They're in a recession, a technical recession, however you want to call it, and they're still hiking away. So at least from his perspective, he'll be in the same boat. ECB's says there's no indication that 75 basis point hikes could not achieve target. So he wants to go full steam ahead. He says they need a few more significant hikes over the coming months. So he wants to pump away. Now, talking about neutral rates and that sort of thing, we've had the Belgian central banker, ECB man Wunsch, however you say it. It's a shame Kay's not here to correct me, but tough. He said it'd be a surprise if the ECB hikes above 3%. That's potentially a key comment because we are looking at where the ECB may top out in hikes. Are they going to go as high as the Fed? That's looking very unlikely, has been for a while. So he's just reiterating that it'll be maybe a push to see rate hikes above 3%. Now, if it is the case that we get to, somewhere between 2 and 2.5% by the end of the year, that only leaves a couple of small hikes or one big hike before they get to that magic 3% number, or his magic 3% number. If that is the case and the Fed are going to continue to hike, it's going to keep that policy divergence in play between the dollar and the euro. If the ECB indicate they're going to go higher, maybe we'll see that policy divergence shrinking. If the Fed are going to get to their 4.5–5% and pause, there's going to be some catch up there. That will impact what happens with euro dollar. Could mean we start to see a bit of a firmer bottom at the very least. Not ignoring everything else that's weighing around the euro's neck at the moment. Onto the Bank of England. It looks like Bailey's warning that pension firms have 3 days to sort their shit out, hit home, because they ended up selling the BOE just under 2 billion in index-linked bonds yesterday, and 2.37 billion in gilts as well. So quite a bit of an increase there. 2 more days to go. We'll see what happens. The argument's going to be, are they going to really end the program or continue it? There are some other facilities in place that will run beyond the actual bond buying. Whether the BOE stick to those or continue, it could be a bit of a frantic Monday if these pension guys don't finish up rebalancing, or if the market takes a sour note on Monday to the end of the bond buying program. If there's further problems in gilts, you're going to see the pressure coming in on the Bank of England and potentially the pound again. So Monday, Tuesday, let's see what happens regarding the Bank of England moves. Over to the good old Fed. We had the minutes, obviously. They don't have as much significance these days as they used to, mainly because as soon as the floodgates open after an FOMC, we get every Fed member speaking 50 times a day, telling us what was going on. So nothing really of note in the FOMC minutes last night. They're going to stay the course. They're going to have to, or they will slow rates at some point. Many saw the cost of doing too little outweighing the cost of doing too much. So self-explanatory there. We know what path the Fed are on, and there was nothing in the minute really to change that. Kashkari was out with a couple of comments last night as well. They said the Fed are quite away from stopping hikes, but he did say that 75 pip hikes is quite aggressive. But the key comment for me was, he said that a strong dollar creates challenges for other countries, but our only concern is bringing down inflation. So that's pretty much sticking 2 fingers up to everyone who's moaning about dollar strength outside of US shores. They're doing what they need to do for their monetary policy and for inflation, and to hell with everyone else. Which falls into what we got from the G7 statement yesterday as well, particularly on FX. Quite funny, really, if you read the note itself. They said they're staying with the same commitment on the FX that they gave back in April 2021, and also even longer. That they're watching FX volatility, or their main concern is volatility in FX markets and the impact on financial stability. But the comments in there, and I'll give you 3 guesses who had this input. They said they will closely monitor recent volatility and that excessive FX moves were undesirable. 5 points to the first person who can tell me which of the G7 nations wrote those lines. No, it's not Powell. He's not a central banker. Sorry, he's not a leader. There we go. Gavin gets it. Japan, Nigel, Japan, of course. So pretty funny there that you can tell from a whole G7 statement who's writing what lines. But the bigger point from that is that, yes, they've acknowledged that there's FX volatility, but there's no real strong language against it. maybe one can draw the conclusion that because they are watching it, that potentially gives the green light to countries like Japan to intervene when things get too excessive. And you can bet your bottom dollar that Japan would have been making that point in the G7. Now, aside from that, we did get Yellen out with comments as well. One of them saying that the situation with the US debt problem is becoming serious. It always becomes serious at a point where it becomes an issue, and we talk about government shutdowns and that sort of thing, and raising the debt ceiling, all that sort of stuff. It's not really a new line from a Treasury Secretary, but again, it's one of these things we keep an eye on. If we start hearing that there's issues, not being able to raise a debt ceiling, blah, 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 then that can create issues down the road because they shut federal offices. That sort of thing can impact the data. It can impact, money given out to people, unemployment, that sort of thing. The US grinding to a halt, and that's the last thing they need when trying to keep afloat amongst inflation. But more important comment perhaps was that she said apparently that she's worrying about the liquidity in bond markets, that the amount of market dealers is not really reflecting the size of the market at the moment. Now, everything that's going on in bonds and yields, it's probably a more pertinent comment to pay attention to, because one of the things that the Bank of England is dealing with is liquidity issues in bond markets. This is all obviously a byproduct of QE. So if she's worried about the liquidity in bond markets, imagine how Japan feels, where they own pretty much all the bond market, or the Bank of Japan does. So what that did is put a little bit of a bid into bonds, into yields in general. And we'll have a quick look at those. Oh, I need to take that off. 1 second. Let's hide that. So let's bring that down a bit. So as you can see there, we've had a little bit of a tip off yesterday's highs on bonds, looking a bit further south. Market may be getting a bit antsy if there's issues. Going to stop selling, and we're going to see a bit of a bid come in and yields dropping. Nothing really to deal with at the moment. One of those. Let's keep an eye on it. The FT was out with a piece saying that hedge funds have been betting on further gains in the US dollar. They were citing some CFTC data, which, if you're not aware, the CFTC futures market, they produce a report every Friday evening of data from the previous Tuesday showing positions in various markets in futures, currencies, bonds, that sort of thing. Now, a lot of the report you'll perhaps hear about is to do with speculative positions, but there is also a report that details institution positions as well, such as hedge funds and other financial institutions. Now, it's a lot of people look at this to try and get a signal for who's long, who's short in the market. It is only the futures market, which is not the whole market, not the spot market or anything like that. So you have to take it with a bit of a grain of salt, but it does give you a bit of an indication of who's long, who's short, what currencies against what. So the FT's picked up that hedges are continuing to be long the dollar against various currencies. I've put that article in our newsroom on the chat room, so if you want to have a look at that in there, you can. Basically, they're saying that as long as the Fed keeps hiking and until they signal they're at a top, they're happy to keep being long the dollar, which is something we're all waiting for. Particularly, I'm waiting for. See if the Fed is going to get to its top and stay there, because from that point, potentially the only way is down for rates, and then we just start to see the big pivot, as they keep calling it. But as far as the Fed are concerned, they're going to keep rates up there for a while, so the pivot may have to wait quite a while, depending on the data, obviously. Let me have a quick check through, make sure I've got everything there. Yeah, we'll crack on. Just looking at a bit of the data quickly. Looking at yesterday, we had the NBA data out. been looking at the housing market for a while, as you guys and girls know. Another set of poor numbers. The trend is continuing there. That's the refinancing index, which is the one that's mostly susceptible to rate hikes. And as you can see, the trend is well entrenched, and we're down and down and down. You'll know we've been looking at the housing market. It has been showing some softness. Prices perhaps are starting to roll. If we start seeing real big drops in house prices, that's when the pain's coming into the market. And then from that, we're likely to extrapolate that to retail sales, and we see the soft landing, crash landing, whatever it's going to be, you know, that's going to start happening. So again, mortgage numbers there not doing an awful lot of good. Over to the US, we had the PPI data out yesterday as well. Now, some people were looking at this and saying, "Oh, it was strong numbers." Depends how you view it. There's several ways to view data, and I'll talk a bit more about this going into the CPI. So the headline CPI number came in at 8.5%, so it beat expectations. So everyone goes, "Oh yeah, it's hot." Yeah, it was strong. Well, no, because it fell 2 pips versus last month. So it was still down over last month, just wasn't down as much as people expected it. The core number, that was down as well, but on the revision, really unchanged, but it still missed expectations and came in lower. So what to take from the PPI, because Estelle said this may be the important number now to watch going into CPI data, the feed through that happens. So on the overall picture, PPI dropped on the month, just not as much as expected, but it hasn't dropped significantly. So it hasn't collapsed. You know, if it had fallen sub 8%, that would have been a fairly decent move, even though PPI can be very volatile. So overall, there's nothing here to change the Fed's view. What this report won't change anything. It says that inflation is still elevated, even if it's softening a slight bit. As I expect, I think we're going to see a bit more of this moderation coming in. So you could call it a strong report in the sense that it won't change the Fed's mind, but it has confirmed that it's come down a bit. So the heat has come off of that a bit. And if we just take a quick look at the chart there, as you can see, it's still continuing to come off the highs. So the trend is starting to come into play, that we're seeing it easing off from those highs. Obviously, if we get back up to those highs, then we've got a different kettle of fish coming. But have we seen a top? Well, there are signs that we have, but where it goes from here, that's what we have to look for. Just looking at some of the other data as well, because we have PPI from other countries. Japan, let's go to there. PPI there up, beating expectations quite significantly, rising over last month. So still quite strong inflation coming into Japan over there. We saw a bit of the data in the Tankan softening yesterday, but as far as inflation goes, it's still heading in one direction. Germany was out with their final numbers, nothing really of note there, unchanged on the HICP, 10.9%, 10% on the CPI numbers year on year. So heavily entrenched inflation there. So let's take it over to the CPI data that's due today. Expected to come in a little lower, 8.1% on the headline. Let me just check that against some of my other calendars. Where are we going? Up here. Yeah, 8.1%. So again, looking for a 2-pip drop in CPI there. The core number looking to rise by 2 pips year on year, 6.5 versus 6.3%. So really, it doesn't matter my view on inflation. You know, all you boys and girls want to know the same thing as I do, is what's going to happen, how do we trade it, and take it from there. So let's bring these charts back in. So CPI is in green, core is in yellow, orange, whatever you want to call it. So for me, it doesn't matter what I think about inflation now. It doesn't matter whether it's going to come up, come down, do whatever. All I want to know is, how do I trade this now? Now, we know it's very volatile at the moment, so I've given it a couple of bands there. If CPI, if the numbers stay within those bands, we're probably going to get limited reaction in the market. I'll say limited reaction. I can't put a number on it. We know that there's enough people out there who are still trying to trade the Fed pivot. So any negative numbers here, even if it's, you know, CPI 8%, whatever, you're going to see a reaction in yields dropping, in the dollar dropping. So what we have to balance out is the numbers against what the Fed are doing. Are these numbers going to change the Fed's mind? Now, unless we see something stupid like inflation falling to 6% and the core falling to 5%, no, nothing's going to change, and I doubt that would change them anyway. So it's really going to be about two things. What's the trend? The trend at the moment is lower in the headline CPI, but it's up in the core CPI. So that's the first thing to watch. If CPI drops to 8% or worse, you say that was negative. But if the core jumps up to 7.8, 7.9%, that's going to cancel it out, any drop in the headline number. So that's the first thing to watch. Match the CPI against the core. Now, let's say, for example, they both moved in the same direction. Okay, if they rise, and they rise significantly, then that's going to put pressure on Fed hike expectations to the upside. So the market is going to see, at the very least, that the Fed is going to be getting up to that 4.5%, 5% mark. And depending on how strong it is, maybe they will need to go higher. That's going to change the expectation upside. Yields are going to rally again. Dollar's going to rally again. You're going to be looking at euro, pound, everything versus the dollar getting hit. Again, it's a question of scale. If we don't break out that sort of band area, and that's really 50 pips either side. So the top of that line up here is 880. The bottom side is 780. So I've given it a rough 50 pip mark either side as a range. So outside of those areas is where we're going to get the more significant moves. But as I say, we need to match this off against the Fed. So if CPI comes in at 8%, let's say the core comes in at 6%, we're going to get a negative reaction because it's softer CPI. But does that change the Fed's mind? Are they going to turn around at the next FOMC and say, we're going to stop hikes? It's not. They're not going to be swayed on one report. So what do we have to do? Well, we have to pick our levels below in whatever we want to trade, be it dollar yen, euro, cable, Aussie dollar, whatever you want to trade. You have to then look at the trade and say, right, the data's soft. It's not going to move the Fed. I'm going to look to fade this. Where am I going to fade it? And then you go to your charts and you pick your levels. You probably want to give yourself something in the region of 50 to maybe 100 pips, depending on what pair, and look at that sort of number as a stretch point for where you want to trade. So let's put that into a bit of an example. Let's look at dollar yen, because that's the easiest one to look at. He says, give me 1 second. Let's get, oh, I've lost all my indicators. Where's all they gone? Oh, see, I play my charts and then I lose everything. Oh, there we go. Right, so as we know, we're knocking on the door of this 147 area. Let's just take it out a little bit. There we go. So if we're going to see negative numbers on the CPI, we're going to see the dollar drop. Where's a good area to think, right, it's not going to change the Fed's mind. Where am I going to fight this? Well, it's going to be somewhere around the 146, the 145, because we had the break point there above all these highs, 144.90s, 145. That's going to be one of those areas I'll be looking at to say, right, okay, you have your moment, Fed pivoters, but this is where I'm going to start fighting you. And if I find the level comes down there, judging the data it holds, that's where I'm going to be looking to get in long, because I expect it to come back up towards these areas here, purely on the fade of that news, because it hasn't changed the Fed. Now, the upside is a bit more difficult, because if you're looking at a pair like this, we're seeing the dollar gaining against the yen again. So where's the upside here? Well, then I'm going to be looking at my big area, you know, the 1985, 1998 highs and the big fib up in the 147s. If we get up to that sort of area from here, what are we, 146.80-ish? That's, for me, is a potential stretch point for the upside, unless we get something silly like inflation making a new high, 9.5%. So if it's in the ballpark, as I showed on the previous chart, that's the sort of stretch area I'll be looking at. It's very difficult to try and catch a data move. So watch the data come out, jump into a buy or sell. The algos are far quicker than we are. It's very hard. The price has already gone nanoseconds before you've even finished reading the number. So what I have to do is look at, what has the market gone too far in a move? If it's going too far, where is it likely to stall? Where are the techs showing up that I can layer a trade in and line my risk up against it? So for something like dollar yen, it's going to be up in that 147s, 147.35 the fib, and then up to that 147.67 the 1998 high. And so for me, it doesn't, from that point, it doesn't matter what the numbers are. It's how do I react to what the numbers come out. My own fundamental view, that'll be adjusted, changed, whatever, after the event. My initial thought is, right, how do I trade this? Now, similar, looking for something like dollar CAD, and this is something I just showed in the room earlier. You know, on a wider basis, we've seen since early October, series of higher lows coming in to this one here, but it's banging its head against this solid 138.50 area. So I'm in a trade. I'm in trade shorts here. I am running buy stops through this area here, but into the CPI numbers, I'm going to pull all my orders. I'll just manage what I've got. I'll either take off the short altogether and wait to see what happens. But it's just as important to manage your trades going into big data and big numbers like this, because you are out on a limb. You know, if CPI if you're shorting up against this 38.50 level and you're short into CPI, it comes in a really hot number, well, it's going to blast through. It's not going to give two monkeys about the techs and your levels. It's going to just rocket up through if the numbers are strong enough. So what I'll do is I'll pull any orders I've got sitting into the CPI, maybe take profit or get out of the short I'm in, let the moves happen, see how the dust settles after. If we get a break up through 138.50, then what I'm going to watch 10, 20, 30 minutes after is what happens if we come back down to this level. Is it going to hold the break? If it comes down and we find 138.50 at support, then I'm going to think, okay, now I can trade the level. But I'm not going to trade any of these little levels over the CPI in the immediate aftermath. So it's twofold. It's about planning to trade the number when it comes out if you're flat and getting into position, but it's also about managing your trades if you are holding positions going into a big number, a big data point. Now, that was something that one of our viewers yesterday, I don't know if he's here today, David, he asked about yesterday, can we talk about risk management and particularly holding on to winning trades? So quickly, I just want to touch on that as well. There's always many ways to trade, as we all know. Risk management is key to that. So the first things first, you know, simple basics. When you look to start a trade, you should always know how much you're going to risk on that trade, and accept that's how much you can lose on that trade. You should always come from the viewpoint on a trade is how much am I going to lose if I do this trade? Not how much am I going to make, how much profit I can make. How much, if everything goes wrong, the worst thing happens, I lose, how much am I going to lose? And am I happy losing that amount? Now, sensible, you shouldn't be trading more than 1% on any one trade. So that's your first instance. If you're happy with your loss, there's no surprises. You don't go offside and think, oh, what do I do now? I'm 2% offside, I'm losing 2%, what do I do? You know your loss from the start. You take a whole ton of psychological aspect out of the trade, all the fear, all the worry, you know what you're losing. But then you've got to learn how to manage trades. And the question on how do you manage winning trades is a big one, because a lot of people exit winning trades too early. Now, there's two ways you can go about it. A lot of the ways that happens to people is they get in a trade, they pick a target. Right, I'm buying this, my target is 80 pips away. And what happens is they may get 30, 40, 50 pips in profit, and then they start getting freaked out. Well, what if it doesn't make my 80 pips? What do I do now? Should I get out my trade, take the money on the table? The fear comes into the trading. You know, can I make what I want? So there's two things you can do. Okay, now I know this is difficult for a lot of the traders in the US because you've got the FIFO rules where you can't do what we call the slice and dice. So one way of mitigating not getting out of trades too early is to take some money off the table. If you can take, even if it's half the money, if you get 30, 40 pips towards your 80 pip target, take some off the table, put some in the bank, bring your stops up to break even, reduce your risk. That's the first most important thing you do after you enter a trade. You want to get your risk to zero. You're happy to lose what you were going to lose. Well, your first objective is to get that down as low as possible and to zero as fast as possible. Then you worry about the profits, because if you get your trade to zero, you're flat. You don't have a loss. You can look after the profits after that. So you can take some money off the table. And if you take some money off the table, again, it reduces the psychological aspect, because you've got some money in the bank. You maybe got your stops up to protect that, at least break even. So if you've made 20 pips, you bring your stop up to minus 20 pips on the other half. Again, your trade is risk-free. Then you can allow the trade to progress, and you can allow the trade to maybe push up to your target level or the next area you want to take some profit. And if you get into that rhythm of doing that, as your trade moves further into profit, you move your stop up behind. You keep trading your stop up behind. It's a bit of an art to work out how far you keep a trading stop. But if you work it purely basis on your risk, so if your risk was 40 pips, you've cut half the trade, now your risk is 20 pips, but you're up 20 pips, so it's flat, then you can just manage it that way. So if you now go up 60 pips, you can bring your stop up maybe plus 10 over your entry point. And slowly and surely, you're keeping your profit in play, and you're locking in more and more and more as it goes. And that's the easiest way I've found to try and stay in a winning trade. You know, I had the $1 trade the other day, where I sold it at 7.18 and it was running all down. I had people in the room saying, "What's your target?" Well, I don't have a target. I don't have targets. Where I have areas where the price may run into trouble, and if we get down to those areas, that's where I take profit, or take some profit, take all profit, whatever, depending on how I view the price action at the time. So it's not about per se having targets, it's about trying to stay in a trade as long as possible. Why not run a trade past your target? Why not take some money off at your target and leave some on the table, bring your stops up, see if you can get a bit more. But it's the way you do it that stops you from having that fear, saying, right, I've got a target of 80 pips, I'm up 40 pips, I'm now starting to freak out because, you know, I don't want to lose the 40 pips that I've already gained. And getting that psychology right in your head enables you to run the trade as far as it can. And sometimes, I say, you'll even beat your profit targets. You'll go way beyond them if the market obliges you. I know Bran, this is something I've been telling Bran in the room for forever and ever. He had issues because he's in the US and he can't trade the slice and dice strategy. He can't take bits off. It's put a trade on, take a trade off. That's the end of it. But now he's in the traders funding program. He's not, what's the word I'm looking for? He's not restricted by those rules, because of the broker he's using. 8cap is not in a US jurisdiction. You know, to a certain extent, he gets around those FIFO rules, and now he can use the slice and dice. You know, and that's one of the biggest aspects of using the program, particularly for those in the US. You know, if you manage to pass and get an account, you can do the slice and dice. You can take some profit on the table. Paul says it there, take money out in quarters, halves. Yeah, whatever. It doesn't have to be quarters, halves. Doesn't have to be a particular amount. Take a small bit, take a large bit. you've got to judge the market at the time. You know, if you're in a trade, like I say, and there's a data point, and the data point comes out and market flies, and you know you suddenly get a big jump your way, yeah, don't look a gift horse in the mouth. Take some money off in case it then all reverses. You know, always take money where possible, but do it in a controlled manner. Right, so let's have a look. That's the lesson out of the way. I hope that's given you all some food for thought. So what are we looking at really from some of the other pairs in terms of levels? We're looking at euro dollar, still sitting in this fairly tight range. You know, take the spikes out, we're really sort of 96, 97s, 97 and a halfs range, maybe 98. So again, you look at the euro and you're going to look at CPI, and is anything going to change the market here? Is anything going to really substantially change the euro? Is it going to shoot up to 110 just because of a bad CPI number? Again, the answer is likely no. This one report won't change anything. So if you get a big rally in something like the euro, then you know, perhaps up to that 98 area, maybe at a push up towards the high 98s, even 99. Those are the sort of levels you've got to think, well, okay, it was a bad number, but Europe's still in the mire, still got the war going on, still got the energy problems going on, still got the Germans heading towards recession. You know, there's no real reason to still be long euro from a euro fundamental basis. So if the market reacts strongly here, what am I going to do? I'm not going to buy at 99 thinking it's going at 112. I'm going to be potentially looking to sell into any rally. Same thing on the dips. You know, we've got this low down in the 95s. We get a move down there on good CPI numbers, as long as it's not huge CPI numbers, then that's a potential area you're going to be looking for a stretch point down into 96, maybe even further down towards the low 95s and that prior low. So it's picking your levels above and below where the market is going into big data. And then you make the call, right, well, I've got something to lean on here. I'll lean on this area, 98s. I'll maybe go with a little short. Doesn't have to be a big trade. You know, if we break 98.20s, then the market's obviously not done with it. So you don't have to risk a lot. Same on the downside. And it's just about trying to catch those stretch points to get the market back to where it was before the data came out, because nothing's really changed. Now looking at $1 as well, and please guys and girls, Gavin's asked about euro sterling. Yep, I'll take a look at that. Any other pairs you want me to have a look at, please do, but give me a little bit of info about what you're looking at as well. Don't just throw up a pair and say talk about that. Let me know what you're thinking of doing if you're positioned, and what you're looking at from a pair. So $1, the PBOC fixed again at 7.11. It was expected to be fixed higher at 7.2. So they're continuing via the fixes to give a subtle hint to the market that they're not going to let this run much more higher, or they're going to keep it on a tighter leash, if you like. We're still finding resistance up towards this mid to high 719s. So it is becoming a key area. But again, a bit like the dollar CAD, you know, we had this move back up. The lows are getting a bit more shallower. Now we're finding support on the bottom of this zone. So it's really a question of which way we're going to go from here. If we move above it, then potentially we're heading back higher, 721s, maybe even towards that high. If we fail here again and come back below, then again, potentially we're going to be heading lower, maybe test some of these lows down towards the low 714s. Again, doesn't really matter from a technical basis. It can either go above this zone or go below the zone, or thrice it just stays in the middle and goes sideways for a while. But still, we've got an area to trade. For me, I might have a little short in this if we continue to fail to break this zone here. But if we do break, I'll let it alone, see what it wants to do. Maybe have a look if we get up towards those highs, 726s again. Euro sterling. Catherine looking to get an Aussie dollar. Yep, no problem. I'll have a look at that. So euro sterling. Well, as you know, this is one that I've traded a lot, beginning of the year through the year. I'm not in anything at the moment, mainly because there's so much mess with the pound. You know, it's all over the shop, and this isn't one currency that usually you see this much volatility in it. But once again, we are down towards the former break point, 87s, 87.15s. So we are pretty much holding down towards there. Below 87, 80, maybe 86.90, then we're looking a bit more bearish, perhaps to get back in the former range that we've seen going on for quite some time. Again, it's a zone situation. We've got this zone 86.45 to 70s, been an on-off pivot point, support resistance. So if we do get under here, that's the area you want to be looking at as the next potential stall point. If you've been shorting up here, that's a sort of area perhaps you want to look to take some money off the table, because if it holds, it's potentially going to ping pong us between there and maybe 87.5, 88s, something like that. I still prefer to play from the long side in this one from a longer term perspective. My only concern is that the Bank of England is going to continue hiking more than the ECB, which will keep the policy divergence in play. That's something that we need to watch very carefully for this pair, because there's still some doubt over how much the Bank of England may hike at the next meeting, depending on what happens with this mini budget and everything going on the political side. If the news is bad in terms of how much it's all going to cost the UK, that potentially is going to feed into a larger hike from the Bank of England. But the expectations really are all over the shop for the BOE at the moment. So it's very messy. If we do get a large hike, the question will be, does the pound gain on such a large hike, or does it lose because it's seen as more of a panic move? So for euro sterling, I'm staying out purely on that volatility and that mess. Gavin, doesn't look euro sterling doesn't look good to me for longs. Every movement spike just seems to get sold into. Yeah, exactly that. I mean, there are levels developing. You know, the 88.60s becoming a bit of a level. You know, the big figure 88. Every time we've got up close to there, 88.10, you know, it's run into trouble. So the levels are developing. So from a short-term basis, you know, you can go ahead and trade willingly. But if you're looking a bit more long-term, like I tend to do, there's a bit of noise going on that I don't really want to get in the middle of right now. Right, so Catherine wanting to have a look at Aussie dollar. So this one is another I'm in, scaling into longs. I'm long from up above. I'm a bit worried, or was a bit worried about this break. We had a move down to 62.50 the other day, and I was looking to see that if we got another test, would it hold? And it didn't. It just broke, even by 10 pips, which is not a good sign when you're looking for signs of a bottom. And even afterwards, you know, maybe if we'd have held the 50 again, that would have maybe negated this move, but we haven't. We've come back through it again, you know, even by 4 or 5 pips. It doesn't look a lot, but when you're watching price action like I do, these little signals just tell me a story. They say, right, we're not ready to bottom there. We're not ready to bottom there. We couldn't hold the previous bottom even by 5 pips, so we're not really done, perhaps. So depending on what you're looking at, Catherine, and trading the data, same thing. If you're looking at this for the CPI numbers, the levels really are a bit short term and a bit messy down here. 62s down into low 62s is an old area. Let's just take that out. I'll just give it that thing again. It's messing me up. So we're getting into some old longer term levels. So, you know, this down at this 62.70 area was a former low in 2020. I need to get my candles back. Sorry, this is all my charts have gone wonky since I changed it for the CPI stuff. But we're pretty much looking back towards what's happened historically back in these areas, and even further. So these are where some of these lines are coming from. So 62.08 is my next support level underneath here. But in the short term, it could go either way. I'll be looking this 40-50 here. If we break under there again, it could be that we're heading for a bit more trouble. If the CPI numbers can't break that, if we get a good set of numbers, CPI, and we can't break that level, that's going to give me a bit more conviction that maybe we're finding a bit of a bottom down here now. Might become a zone 40-50, who knows? But that'll be the sort of area I'll be looking at. If it can't break, then potentially we're finding a bit of a longer term bottom, and then we can look at the upside, which at the moment is contained around this 63 level. But all this is very short term, you know, unless we start getting up back above 64s, the bearish trend remains firmly in place. A bit like dollar yen in the uptrend. You know, this is the Aussie dollar equivalent of maybe 145. And so the break below is holding below. It indicates that perhaps we're not done dropping in this pair. But yeah, if you're looking at levels, probably 62 on the extreme on the downside, 64s on the extreme on the upside. Martins wants to look at the DAX. Oh, throwing me a little bit of a curveball there. Again, you know, what are you looking at, Martins? Are you in a trade? You're not in a trade? You're looking for just some levels to pick between the thing. It's not something I look at for trading wise. I know a few guys and girls look at it in our trading this actively in our chat room. It's not something I trade actively. I just look at it, monitor it as a part of whatever else is going on in stocks. But let's see what we can do for you here. Well, that's pretty clear in the first instance. We're obviously in a bear trend. Again, it's really about the levels. You know, we found decent support down towards the mid to high 119s. That's going to be your marker on the downside from here. If we get down there, test and hold, give you a bit more conviction that we've got support building there. We've got real support building there. Again, the price action, if it just comes below that low, you know, even by 10, 20, 30 pips, we're not done. We're not done with the moves lower. So if you're thinking of trying to catch those knives, you've got to be a bit careful. Same with the upside. For me, you've got a bit of a, you know, you can obviously see the downtrend coming off of here. So let's just stick a line in there. Just to get this right. You know, just for a short-term basis. So if you want to know where we're going to start potentially turning this trend around, at least in the short term, that's the sort of area you've got to get above. What we're looking at today's money, around about, you know, 131, something like that, maybe a bit higher, 132s. Depending on your text, I mean, for me, it's pretty simple. You know, that's a pretty blank chart. What I mainly look at is the prior support and resistance areas. That's the first thing I look at if I've got a blank chart. When I first start drawing on the chart, that's what I look at. I'll look at where the highs and lows have come in over what sort of time frame, and that becomes my basis for starting to build a technical picture. You know, that comes from up here because we've got a pretty significant looking double top. You know, you can draw your fib from there. You can start building up your technical picture, see where your levels are coming at. But for me, if you're just looking from a short-term basis, you know, into this 119, 70s, whatever it is, that's going to be the point to watch for support. If we get a similar move like this, where it comes down to maybe, you know, 120, can't quite hit that low support there, then you've got a similar picture where you're going to perhaps see a decent move up. And that could be what's happening here. You know, we've had this low, can't quite get down to that low. Where's it going to go from here? This could mean a push up, but take the time frame into consideration. This is just a daily chart, but if you take it on a shorter term chart, you know, here's where your resistance is, at least in the short term, around about you know, 121 20s, call it that. On the top side, 122 80s, 90s. that's the area we're pinging around in the short term. So look for moves either side of that. Brian, how much correlation do you see between Euro sterling and GBP and cable? There's obviously a big correlation between them because Euro sterling, like geographically, it's a strong currency between the pound and the euro. But you've got to look at what's moving what. It's all about what wind's blowing. So for Euro sterling, if Euro sterling's moving, you've got to look, is it the pound moving or is it the euro moving it? But in terms of cable and the euro dollar, if the dollar's moving, as we've shown time and time again, cable's likely to move more than euro dollar will in when it's the dollar moving, just because it's not as big a currency. And that then becomes reflected in euro sterling. So if you get a dollar move, let's say dollar's going up, so pound and euro going down, or cable and euro dollar going down, most likely that euro sterling isn't going to do anything. But if the volatility is greater in cable and that moves more than euro dollar, that's when you're going to get moves in euro sterling. Excuse me while I take a glug. Right, just looking at the clock, that's the time's ticking on. Merl, EuroCAD looking to short due to stronger oil. Let's have a quick look at that as well. One thing I'm worried about, particularly with CAD, is it doesn't seem to be on the connection with oil. It doesn't seem to have the correlation at the moment with oil, at least a strong one. I've been watching that in dollar CAD mainly. So this may be a stronger one. I don't know how the correlation is playing out in this at the moment. Let me take a quick look at oil. Still looking low. So yeah, maybe a bit of a stronger correlation going on here. So if you think oil's rising, then yeah, perhaps this is the short to get into, at least because you know that the euro is a bit of a crappy currency at the moment. So if you want a perfect wind, you want euro weakness and strong oil. But then you've got to ask the question: does Europe getting weaker in terms of its fundamentals mean oil's going to get stronger? It mean less demand, so prices drop. Technically speaking, here's the big old support line that many of you have been on the Flow Show for a while and listening to Kay. This was the big one that we traded quite significantly when it happened. Big support point, caused the breakdown all the way down here. On the top side, you're talking 37s, 68s up towards this 37 area. That's going to be your main resistance point. So from technical basis, that's the sort of area you're going to be looking at, so I'd be looking at for potential shorts. Hope that's got your question there. How do you trade it? Well, there you go. You look at your levels, particularly this 134 area. If you want, what you want to see, if we start to build decent support on that, let's take it down to a bit short term again. If we're starting to build decent support off of that, then you're potentially going to get some upside. So if you're looking at shorts, you're going to be, and you get into shorts, you're going to need to look at this 134 level again, because if you can't get through that, then if you're short, you need to know how to react to that. As I say, maybe take some money off the table. Right, whew, that was a lot again today. So just to repeat, big day for the CPI. Make sure you're protected if you're in trades. There's nothing wrong with getting out of a trade. Even if it's running a loss, you can always re-enter afterwards. What you don't want to get into is just leaving positions on over big data like this and just basically gambling, saying, well, it might go my way, I'll chance my arm. You can do that if you like, but if it goes wrong, you've got no one else to blame but yourself. It's better to take a small loss and be right than a bigger loss being wrong. But I'll leave you to trade your own accounts the way you see fit. As always, we'll be covering this on the face webinars and plenty of analysis in the room and all the price moves. So for those guys and girls who are in the room, tune in, because no doubt we'll have plenty of analysis on that there. Trade safe, boys and girls. Thank you all for coming to the Flow Show. I hope it's been of use to you, and we shall go through the aftermath of the CPI tomorrow. Thank you very much. Have a great day.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.